All right, guys, welcome back to the Independent Investor Channel. My name is Ryan. Your ability to be successful in the stock market will be your ability to self-assess and take a critical look at your own capability, your own portfolio, how it is that you're aligning your exposure rate to the stock market with your own risk tolerance. And this is a real deficiency that I see a lot of times in a lot of portfolios that are disclosed over YouTube. What I find a lot of the time is that you get kind of in a rut. You prescribe to a particular method of investing, and you don't have the ability to hear out other aspects of investing. And I really feel like this is a huge, huge discredit. And if you really want to pursue success in the market, you're going to have to be able to critically assess where you are in the market. If somebody were to come to me and say, Ryan, I would take a look at this, this, and this in your portfolio, I would listen. I would absolutely listen to that constructive criticism. In this video, I'm going to review a grouping of stocks. I hardly call it a portfolio, to be honest with you. But I'm going to offer my constructive criticism over this grouping of stocks that exist within a portfolio. I'm going to offer some areas of improvement, what I see from the portfolio, how it's returned over the last 5 years, how it's performed in relation to the total overall market, and just offer my thoughts on this particular offering over the YouTube community. All right, guys, so without further ado, I'm going to kick you into M1 Finance, which I'm going to use to kind of mimic this portfolio and declare my thoughts on the portfolio for you guys. So I'm going to drop you into M1 Finance. Please enjoy. All right, guys, welcome into M1 Finance. I thought this would be the best way to display this this review of this grouping of stocks here. This is a primary portfolio here. This will only take me a few minutes, and this video I just want to premise is for entertainment purposes only. And I really want to put my twist and spin on this particular grouping of stocks here. You guys notice that I'm not going to refer to it as a portfolio because it's not. Taking and putting 11 stocks from the total stock market into any account, whether it be a retirement account or a brokerage account, is just that. It's a grouping of stocks. And what I'm going to try to do is offer my perspective on what I see on the surface. Obviously, I don't know what's going on with regard to the funding schedule over this portfolio, whether or not there's a dollar cost average schedule that is assigned to this account. I would go out on a limb and say that there's probably not. There's probably more of a strategic buying type of application, which I absolutely am in favor for. On the onset, when I do just a compulsory review of this portfolio, I'll scroll down and show you guys what you're seeing here is the 5-year rate of return for this portfolio. Obviously, we have the benefit of back testing the portfolio, and M1 Finance allows us to do just that. And where you see here with the amount of risk that we're taking on in this portfolio, I find it ironic that we're not even outpacing inflation in this portfolio. And I'm going to try to be as constructive as I can with my analysis of this portfolio. My opinion is only so justified with regard to my experience in the stock market, not necessarily indicative of the fact that I run a fairly small YouTube channel and offer my perspectives through that YouTube channel to my subscriber base. So my opinion is coming from my singular lens, and it does prove a couple things with regard to my contention that every portfolio is different, and the portfolio should be built in a way that reflects the individual holder's risk tolerance. And I will say that just reviewing this portfolio, I will not be disclosing anything with regard to reference to the owner. This will be completely anonymous. That's the way I choose to do this review. I will not be providing anything other than my valued assessment over the holdings within this portfolio. But let's cruise down here. This grouping of stocks is contained. It's got 11 names here, and this is what we've got, so you guys can see on the screen. I like how M1 Finance allows us to do this. This can be done with any grouping of stocks or portfolio. Whether or not you do it with single stock or ETFs is irrelevant. I just think the function and being able to demonstrate how 100% of the pie is split up across these 11 slices. In this particular case, they are individual stock holdings. The first being Facebook. I will just say, just right off the offset of this portfolio review or this grouping of stocks, there's only really one stock in this portfolio, one out of the 11, that I really feel like is really the cream of the crop, and that is Facebook. It's easy. Facebook, based on valuation, balance sheet, target risk for an investable asset, what they bring to the table, and also some of their businesses that they own on the side. I think investing in Facebook to own a piece of Instagram is absolutely justified enough. But when you talk about the free cash flow and the clean balance sheet that Facebook is working with, I feel like Facebook, for a lot of large companies, it's not an option of whether or not they can do business with Facebook. It is an absolute necessity for businesses to pay Facebook for the ad revenue that Facebook collects when representing the majority of the big companies that do business with Facebook. So I'm ecstatic to see Facebook as a holding in this portfolio. However, a 20% allocation to any single name, and I'll try to be as nice as I can, is extremely irresponsible in my opinion. And again, this review of this portfolio is my assessment based on what I see. So the recommendation for fixing this isn't to change the name itself. I think Facebook is a fantastic investment, but when you're talking about levering any number of dollars, the dollar number is irrelevant when you're talking about allocation. Allocation is the key in this exercise. And one thing you guys are going to notice about this portfolio, it is absolutely 100% void of any type of pursuance of diversification. This is an example of what I see not only from this particular owner, but a lot of YouTube portfolios that are declared a dime a dozen, I may add. Even in, this is a growth portfolio, but especially along the dividend portfolio group, and that they're declaring their group of holdings, and they've got 10 or 15 holdings, and they seemingly either don't care or are not taking a concerted effort toward attempting to diversify their portfolio. And that's really, really sad. The interesting part about this particular portfolio rendering as little as it can, this anemic 1.53% return over the previous 5 years, is, compared to the market, this is unacceptable, quite frankly. I could have entered into any ETF bond portfolio and absolutely crushed this right here and taken on a significant amount less of risk by doing so, and at least I would have outpaced inflation. This is failing to do so and taking on a significant more amount of risk within this portfolio. The remainder of the holdings, from a single company perspective, I actually like a lot of these names. I really do, in all fairness. However, when I look at the heavy weighting of this portfolio toward the growth side of the house, which is indicative here of a very anemic 75 basis points of dividend yield within these 11 holdings, this is really skewed toward the growth aspect of the portfolio. Now, that doesn't mean that it's a bad thing. It just means that this portfolio, in my opinion, is incomplete. And I think if you grouped this groupings of holdings here and built a slice and made this a growth aspect of the total overall comprehensive portfolio and added it into one of these as a slice, a growth aspect to the portfolio, and then just continued to build the portfolio out with some passive assets, some dividend income payers, some real blue chips. And I know just if this is held by the owner of this group of stocks as a primary source of investment dollars, then it's probably not in line with the holder of this portfolio's objective to introduce a whole lot of dividend paying stocks within this to really complement the portfolio as a whole. So there's really a lot of potential here, and what that ends up doing is it takes some of these target allocations here and doesn't put so many dollars into these growth names. It still doesn't prohibit you from investing in any of these names. Quite frankly, I don't have a problem with any of these, to be honest with you. I'm not an investor in, like I said, personally, I wouldn't invest in 10 out of 11 of these names. That's just me personally. In order of precedence, it would be Facebook number one as an investment. It would be Nordstrom from a value perspective. It would be Wynn, actually, I like as a company. I like the casino space. And then Skyworks. And then it quickly falls off for me from a value perspective, in that I do own some of this space, but I own it through surgical robotics instead of this iRobot. This is a $2 billion company, a very, very small company in retrospect. And then you've got Uber and Tesla, which as companies I really like. As stocks, I despise. I think they're terrible investments. Now that may prove to be very, very rewarding for the individuals who are looking to gain exposure to these two companies, because I think there's really going to be a large payoff down the line. But for right now, neither one of these companies are actually generating a profit, which from a value perspective doesn't make any sense. From a growth perspective and being opportunistic in your deliberation, whether or not making these an investment, absolutely could play into that decision. But to fix this portfolio, that's what I would do. I would take this and I would add it into a slice here. Now, not to just completely condense this growth aspect down in the portfolio and make it what I would recommend between 5 and 10%. Obviously, growth is very important to the owner of this portfolio. What I would do is take it and pick the percentage of exposure to this growth slice that would be indicative of their desire to seek out growth. What I mean by that is, why not take this and make it a slice in the portfolio at 25% or 50%? I just don't understand the philosophy or the goal of having the majority of your assets tied up in these 11 names. And it isn't specifically the names that I have a problem with. It's the total portfolio allocation or the lack thereof in other aspects of the portfolio, such as diversification, such as dividend growth, such as maybe even some fixed income to help buffer a potential downturn in the market. Now, depending on the age of this particular portfolio holder, it may not be the most appropriate to start to add some fixed income into the portfolio. However, when I look at the portfolio performance over the last 5 years, there may be some potential there for some self-reflection and ask, whether or not they're really that good at picking individual stocks. I will just say this. Most people fail at picking individual stocks and drastically underperform the stock market year in and year out, and it becomes significantly more damaging over time when this is allowed to fester. And I think it really comes from a perspective of naive ignorance, to be honest with you, to deploy a strategy to where there's really no clear objective here in what we're trying to perform. If historical performance is any indication of how this portfolio is going to perform, furthermore, this is how it's performed in a bull market. How is this portfolio going to perform in a significant bear market or a prolonged recession if this is what it's been able to provide, this anemic rate of return over the last 5 years, going into what I feel are the latter innings of this particular bull market? And it's something that I would really wish upon or insist that the owner of this portfolio look at and really look to not reduce these holdings in any fashion, but look at this as an aspect of the portfolio and not as a reflection of the total overall portfolio value. I think there's a lot of work here to be done on a lot of different aspects of seeking your participation in the stock market, and I think that this portfolio is void of those aspects. Becoming an investor is one of those things to where you don't have to subject yourself to one style of investing, this being indicative of a growth style of investing. Why not pursue other proven methods of investing in the stock market? And there are a ton of them. Dividend investing, fixed income investing. This is the growth aspect of the portfolio. And I talk about alternative methods of making sure that the money that you have is as sheltered as it can be from the tax implication, as well as for the smaller investors out there that are eligible for contributions to a Roth IRA, to make sure that you're maximizing your capability to wealth preserve money within that. And I know a lot of people will just scoff at that or won't hear what I'm talking about, but it can be one of the most costly mistakes that you can possibly make in your investing career if you just continue to allow something like this to fester. And it's going to be very, very interesting to see how this portfolio performs during a downturn, because when you own stocks like this that are high growth, high beta in the stock market, these are typically the ones that are the most subject to downturn when the entire stock market is in a free fall or in a downturn. These names, just like every other name in the market, are not going to be immune to that downturn. I would contend that they are going to be subject to the largest percentage of downturn. So I hope you guys enjoyed. This was my constructive review of this particular grouping of stocks. This is 11 holdings with a fairly anemic dividend yield, a rate of return over the last 5 years that's rendered 1.53%. I'm a numbers guy. The numbers typically do not lie. It's typically better to just look at the numbers as opposed to me giving my emotional review of this portfolio. I think it would be a hell of a lot more entertaining if I gave my R-rated version of my review over this portfolio. But to keep it constructive, I've offered this constructive review of this particular portfolio, and I hope you guys have enjoyed this review. And obviously, we want to offer our own constructive criticisms or positives that we see in this portfolio in this review. So thanks a lot, guys. I really appreciate you joining me. I'll kick you back over to YouTube now. Thank you. Right on, guys. So welcome back out of M1 Finance. I hope you appreciated this. I say this all the time. There's no one portfolio that needs to be the same. But I do contend that your portfolio needs to be reflective of your own risk tolerance. And I think a lot of people drastically overshoot where they are with their risk tolerance and become a little bit complacent, especially in this bull market, to where they only look at the one side of the market going up every day and not acknowledging how violent the stock market can be on the downside. And I really think you need to be constructive in reviewing your own portfolios and making sure that you're taking a defensive posture, looking at some of the attributes that are indicative of a defensive portfolio, which will really expose you to less risk on the downside, but make sure that your long-term goals are not affected by an underperforming portfolio from year in and year out. So I hope you guys enjoyed this review of the 11 stocks that I reviewed in this particular grouping. If you like the message that we're putting through, don't hesitate, hit the subscribe button, help us support the message, share it with anybody out there that you know can benefit from the information. And finally, leave your comments in the comments section of this video. Guys, thank you so much for tuning into this portfolio review, and good luck in your investment future.